Okay, so we hear so much about the national debt, don't we? Trillions and trillions. These numbers that are just almost too big to even think about.
Yeah, they really are. Kind of abstract for most people.
Right. But what if the real sort of financial squeeze, the quiet crisis that's hitting millions of Americans day in, day out,
Mm-hmm.
what if that's actually much closer to home?
Mm-hmm.
Today, we're doing a deep dive into exactly that, this rising tide of consumer debt. And we're using a really insightful piece from Coin Bureau, The Hidden Consumer Debt Crisis in America, as our guide here.
That's exactly right. And our mission today really is to pull back the curtain, to look at the sheer scale, the different types of debt, and, what it all means,
Hmm.
how people are borrowing here in 2025.
Okay.
Because, you see, while Washington talks national debt, this quieter personal debt crisis, it might actually be way more pervasive, maybe even more dangerous than folks realize.
Mm.
So we're going to pull out the key takeaways, the real nuggets from this source, to help you get properly informed on, well, what's a really crucial topic.
Okay, let's unpack that core idea then. The source is basically arguing that, yeah, federal debt gets the headlines, but it's consumer debt. What individuals owe, that's the real threat to household finances and maybe even a drag on the whole U.S. economy.
Precisely.
So when we say consumer debt,
Hmm.
what exactly are we talking about? What fits under that umbrella?
Right. So consumer debt basically covers four big areas.
Hmm.
Credit cards, student loans, mortgages, and then this newer kid on the block, buy now, pay later, or BNPL.
BNPL, yeah.
And here's the big number, the headline figure, total consumer debt. It's now over $18.2 trillion.
Wow.
That is, without a doubt, the highest it has ever been in American history.
18.2 trillion. That's really hard to wrap your head around. Okay, let's start with one people know well, maybe too well. The plastic trap, credit cards.
Mm-hmm.
That debt is now over $1.88 trillion. And that's like a 50% jump just since the pandemic lows. That seems incredibly fast.
It is a massive jump. And the tricky thing with credit cards, the real danger, is that it's revolving debt.
Right.
It's not like a car loan, fixed payments. This stuff can just roll over month after month. And the tough truth is, a lot of people can only swing the minimum payments.
Which barely touches the principal.
Exactly. And you add average interest rates that are consistently over 20%, sometimes way higher, store cards hitting 36%, even pushing people towards bankruptcy. It just becomes insanely expensive borrowing.
Yeah.
We're seeing almost half of people with cards carrying a balance now. And delinquencies, they're creeping up. Slowly, but definitely rising.
And what really jumped out from the source for me was why people are racking up this debt. It isn't mostly fancy vacations or gadgets, is it?
No, not at all. That's the key insight. It's overwhelmingly for essentials. We're talking groceries, utility bills,
Yeah.
Unexpected medical costs, things people need to live.
Well, what does that tell us if people need high-interest credit cards just for the basics?
It tells us incomes just aren't keeping up with the cost of living for a huge chunk of the population. It's a fundamental pressure. The credit card has gone from convenience to, well, a lifeline, a stopgap measure. And the source had this great analogy. Credit card debt is like a treadmill with the speed constantly increasing. The more you try to keep up, the harder it becomes to stop without falling.
That's a powerful image, a real vicious cycle. Essential spending leads to high interest, which eats up more budget, leading to more borrowing.
Wow, precisely.
Okay, so that's the sort of traditional trap. But you mentioned buy now, pay later, BNPL. That's seen like explosive growth, right? Especially with younger people, Gen Z, millennials.
Absolutely explosive. About 1 in 5 Americans are using it now. It exploded during the pandemic.
So what's the catch? Convenience sounds good, but...
Well, the convenience hides some pretty big risks. The main one, usually there are no credit checks, which means you could sign up for, 5 different BNPL services, run up debt on all of them, and no single lender or even the credit bureaus really sees the whole picture.
So it's hidden debt.
Kind of. The source calls it phantom debt because most of it isn't reported to Experian, Equifax, TransUnion. It exists. It's real debt you owe, but it's invisible on your standard credit report.
Until
you miss a payment.
Exactly.
And then the late fees can be brutal, sometimes up to 50% of what you bought. And that can get sent to collections, and that definitely hits your credit score hard.
Okay, that's sneaky.
It is. And the projections. This BNPL debt could hit $700 billion by 2028. That's a huge potential blind spot.
Right, like having a bunch of browser tabs open for small buys and you forget about them until suddenly your whole system crashes.
That's a good way to put it, yeah.
Okay, let's shift gears to the big one. The foundation, traditionally, of the American dream, mortgage debt.
The biggest piece by far.
Americans owe, what, $12.8 trillion across 85 million mortgages? That's like 70% of all this consumer debt we're talking about. What's the situation there?
It's interesting right now, kind of a mixed bag. On one hand, you've got millions of homeowners sitting in what they call golden handcuffs.
Golden handcuffs.
Yeah, they locked in super low mortgage rates, maybe below 3%, during the pandemic refinancing boom. So now, even if they wanted to move, they won't sell because they'd face current rates around, what, 7%?
Ouch. Yeah, big difference.
Huge. And that's keeping housing supply really tight. It prices a lot of new buyers right out of the market. Now, delinquencies are ticking up a little, but serious ones are still pretty low, around 0.7%. Manageable for now.
But isn't there also a massive amount of home equity out there? People own a lot more of their homes now compared to, say, 2008.
That's the other side of the coin, absolutely. Homeowners collectively have something like $34 trillion in equity. That's a huge cushion.
So less risk of a 2008-style meltdown?
Definitely softens the systemic risk, yeah. That equity buffer is significant. But, the source still uses this metaphor. Mortgages are like anchors, solid and secure, until rising interest rates and delinquencies turn them into financial quicksand.
So stable overall, maybe, but still risky for individuals caught on the wrong side of rate changes or job losses.
Exactly. The personal risk hasn't vanished, even if the system-wide risk looks different than '08.
Okay. Let's talk about the last big category, one that impacts millions and feels, I don't know, uniquely burdensome today. Student loans, a degree in debt.
Yeah, heavy one.
The total is $1.88 trillion, right? Spread across 43 million people. Average debt around $38,000 each. What's the situation now, especially after the pandemic payment pause ended?
It's been a real shock to the system for borrowers. After that pause ended, we're now seeing over 20%, 1 in 5 borrowers, are 90 days or more delinquent on their payments.
20%? Seriously?
Seriously, it's a record high. And while, there were some targeted cancellations, about $180 billion worth, the big, broad forgiveness plans, they got struck down.
Right.
So the vast majority of people are facing those payments again, and clearly many are struggling significantly.
That 90-day delinquency number, that's really stark. What's the deeper implication there beyond just the number? What does that do to people, to the economy?
Well, one thing the source highlights is this multi-generational impact. It's becoming really common.
How so?
You've got parents, Gen X, even some boomers, still paying off their own student loans from decades ago. And at the same time, they're trying to help their kids pay for college now, often taking out more debt, like parent PLUS loans.
Wow, paying backwards and forwards.
Exactly. And think about what that means for young graduates. The promise was, get a degree, get a good job, achieve upward mobility.
Yeah.
But the source puts it bluntly. Now it delivers a payment plan before your first paycheck.
Yeah.
It fundamentally changes the starting point for so many young adults. Makes it harder to save, to invest, maybe you buy a house, all those traditional markers.
Okay, so we've got all this debt, credit cards, BNPL, mortgages, student loans. But who? Who actually owns this debt? Who's on the other side of that $18.2 trillion?
Yeah, that's where it gets really interesting. It's not simple. It's quite fragmented, actually.
How does it break down?
Okay, so credit card debt, that's mostly held by the big banks, Chase, Citi, BofA, the names. But also fintech companies and retailers themselves.
Right, store cards.
Exactly. Then mortgages. They usually get originated by a bank or lender, but then they're often sold off to Fannie Mae and Freddie Mac, these government-sponsored enterprises.
Okay.
And Fannie and Freddie often package them into mortgage-backed securities, MBS, and sell those to investors on Wall Street. Spreads the risk, frees up bank capital.
Sounds familiar from 2008.
The mechanism is similar, yeah, though regulations are different now. Now, student loans are unique. About 90%, the vast majority, are held directly by the federal government.
90%. So taxpayers are ultimately backing most student debt.
That's basically it.
Yeah.
If those loans aren't repaid, it hits the federal budget. And then BNPL, that's mostly held by the fintech firms offering the service. Or sometimes they sell bundles of that debt to investors too. It's still pretty opaque, that market, largely unregulated.
So it sounds like, I don't know, the average American household has almost become like a mini hedge fund, super leveraged, and the risk is scattered everywhere. Banks, government, Wall Street investors.
That's actually a pretty good analogy. Heavily leveraged, risk spread wide.
Does spreading it like that make it safer or just harder to see where the real danger lies?
Well, it probably prevents one single thing from bringing down the whole system, like one bank failing. But It also means the overall health of the consumer. Their ability to pay all these different debts affects this huge interconnected web.
Right.
Banks, investors, the federal budget, they're all exposed. It doesn't eliminate the risk, it just diffuses it. And it makes this slow squeeze we're talking about feel, well, pervasive.
Okay, so let's connect those dots. All this individual debt, the squeeze. What does it mean for the bigger picture, for the whole economy? Why should someone listening care even if their finances are okay?
It matters hugely. Let's look at the interest alone. Collectively, Americans are paying over $560 billion a year just in interest payments on all this consumer debt.
Yeah. $500 billion.
Yeah.
Just in interest.
Yeah. Think about that money. It's not going to buy goods and services at local businesses. It's not being saved for retirement. It's not being invested. And remember, consumer spending drives something like 70% of U.S. GDP.
70%. Wow.
So if more and more household income is getting eaten up by debt service, that's a direct brake on economic growth. Less spending, less demand.
And that creates wider risks.
Definitely. It creates systemic risk.
Yeah.
As delinquencies rise, maybe in credit cards first, then maybe student loans follow. Banks get nervous.
Yeah.
They start tightening lending standards, maybe raise interest rates even more, pull back on making new loans.
Which makes it harder for everyone else to borrow.
Exactly. Creates a feedback loop.
Yeah.
Tighter credit slows the economy further, which might cause more people to struggle with payments, leading to more defaults. You see how it can spiral.
Yeah. And this ties into what the source called a recession warning, right? If defaults start piling up across multiple areas, cards, BNPL, maybe mortgages, student loans, it could really choke economic growth.
That's the concern. And the bottom line from the source, it's pretty sobering, worth really thinking about. America is entering an era not of crisis, but of slow squeeze. An era where debt quietly erodes growth, optimism, and mobility.
A slow squeeze. Not a sudden crash, but this ongoing grinding pressure.
That seems to be the picture, yeah. A persistent drag.
Okay, wow. That is a lot to digest. So just to quickly recap the key points from this deep dive for you listening. Consumer debt in America hit an all-time high, over $18.2 trillion. We're seeing real signs of strain, of rising pressure across the board, credit cards acting like a high-speed treadmill, the hidden risks in buy now, pay later, the complex situation with mortgages, and those record delinquencies in student loans.
Right.
For a lot of Americans, interest payments are becoming one of the biggest lines in their budget. And these aren't just individual problems. They add up to a real threat to the whole economy, potentially leading to this slow squeeze on growth and opportunity.
Well said. And maybe a final thought to leave you with, something to mull over after listening to this. If this slow squeeze continues, this persistent pressure of debt, what does that mean long term?
Yeah.
What kind of impact might it have on, say, future innovation? Or on people's willingness to take risks, to start businesses, and that whole spirit of entrepreneurship, or even just the feeling, the perception of the American dream itself for the next generation?
That's a big question.
It is. We'd really encourage you to keep thinking about these trends, how they might play out in your own financial life, and how they fit into the larger economic story unfolding around us.
Jen.